Hey everybody, this is Paul doing a quick dividend video here. The market is currently open. It is the 28th. There's very little news that's going to come out between now and the end of the month, but I think we can get a general idea of like what's going on, how the market performing, that kind of thing. As you can kind of tell by the portfolio here, hasn't been pretty in September, let me tell you that. But you know, this was expected, fully expected. So let's go over the stocks, tell you like what's going on here. Okay, so BSTZ, BST, tech focused stocks. I'm you're gonna kind of notice a trend here in a second. So bond yields go up, tech stocks go down. Okay, so then we have SPHD, which yields 4.65 now, actually, which is pretty nice. But it's not yielding, something like this, or definitely something like that. So value stocks get hit. So this is a value stock, basically. It's a combination of a bunch of value stocks. Dividend payers, that's literally what it means. Oh, so why is O getting hit? You've seen a bunch of videos. They have 99% occupancy rates. They're the people who rent from them are some of the biggest companies in the country. They're not going to miss their rent payments anytime soon. Here's the problem, and this is what I went over in my last video, is that O has to go to the bond market every once in a while. So they will put out notices that say issuing $1 billion in debt for general operations is how they'll word it on their thing. The last time that they released one of those was June 29th, and they haven't released one since because rates are probably so high that they're trying to use their current free cash flow to do their general operations. Because nobody wants to be issuing debt if this is what you're dealing with. This is on the coast. So if you go to the corporate side, so this is what the corporate side is having to deal with. So even AAA companies, which there's only like two of them, are sitting here with something like this. And they normally will issue 1 year bonds. So if O's down here, for example, and you can kind of see who's down here trying to issue debt right now. But this, you kind of get the general idea. Like, see, these are the rates that they're at. You have to look inside the actual bond itself to see how much they're trying to issue it for. So you can kind of see there's a lot of companies down here trying to issue debt. Well, O's one of those companies, and it's a real estate company also. So if they try to expand operations, if they try to buy new buildings, they're subject to the same rates that everybody else is subject to. So O is getting slaughtered at the moment. Um, I actually added O. I'll show you what I added here in a second. HYG, another example. So this is high yield. So this is the crazy part. High yield sitting at 5.85% yield. And this is the most risky stuff. But a 3-month treasury sitting at 5.4, or a money market fund is sitting at 5.5 if you get the right one. What are you going to pick? Junk debt, or are you going to pick, you know, um, U.S. government bond, right? And then we have AFB, of course. So this is a tax-free yield. It pays out tax-free, but the problem is, same thing, 4.23%. Money market funds, the one I'm in right now, 5.99%. So you see the issue. So that's kind of what's going on. So, and it really doesn't matter what you're in right now. Pretty much the only thing that you could be in that won't get hit is maybe energy. Maybe something like, some of the things that rallied yesterday, like Exxon, that kind of thing, because as oil is jumping around. But as you can see, it was up 3% yesterday, now it's down 2%. So, there's not very many places at all to hide in this market unless you're doing options and you're short the entire market. But even then, if you're short, you try to carry that short into the day, you get destroyed. So, what's what's going on? It's very weird that there's certain Fed members that are actually coming out literally saying they don't know why the long end is going up. I think it's pure stupidity. It's pretty obvious why the long end is going up. So here's why, and I'll put this link inside the YouTube comments so that you can see. We're issuing tons of debt, as you can see here. Look, so this is just the debt that was issued in. Um, so where are we at here? We're not even there yet. So this is just the debt right to here. This is just what was issued, and you can click on each one of these, but this is what was issued into, into September and August. This is a massive amount of debt that's been issued. So, it doesn't take a genius to kind of figure out why, and it's all been issued on the long end and the short end. And then if you go to upcoming auctions, October is not looking any better. This is this is going to be kind of rough. The beginning of October is not going to be pretty. Um, that's a lot of debt for the market to take up right there. That's a lot. So you need to start watching this site. So this is definitely where you need to start watching. And it's basically, if you want us to buy your debt, well, you better pay us. And if you want us to buy your debt out here, then you better be willing to pay up, because we can just get this debt down here. So that's what's going on. It's driving up rates and it's driving down the market. So that's how you can go from 4,600 down to 4,250 or so, whatever we ended up yesterday. So this is just a line that I threw on a chart, as you can see. And the market kind of bounced. It went through. This is not a log chart, but if you put it on a log chart, it went through this line, this resistance line. And then it literally, it tried to push through that line. It couldn't push through that line, which is interesting, because that indicates there's not a lot of selling, a lot of selling down here. There will be if rates stay this high. But as you can kind of see, it tried to push it pushed through the line, and then it immediately bounced, and then you kind of get this little relief rally that we have here. Pretty much everything was flashing oversold yesterday, so everything just kind of everybody just kind of jumped back in. So you can kind of see. So basically, there's the October low, there's the March low, and if you follow the trend line, it put in a little bit of resistance right there. Um, the guys who trade options, they follow this stuff sometimes. Some people call it voodoo. The only thing I know is that algorithms are programmed with this in mind, to look for technical levels to bounce off of, because that's where the buying comes in. That's where the options guys and individual traders come in. So algorithms are based off of this stuff. You can ignore it all you want, but this is how it works. You can kind of see in March, bounce right off the trend. So that's kind of where we're at right now. So what else is going on? So it's basically, I've been building up my savings, as you can see, getting ready to deploy money. I think we have to hear the Fed say the word pause to get anything kind of like rally out of this. Now, October, November, and December are typically good months to rally. September is typically where you get your really bad sell-offs. October you can get sell-offs too, obviously. But I think the beginning of October is going to be pretty nasty. If you take this plus a strong jobs report, it's probably going to, we're probably going to go down. I'll be surprised. But the market could easily absorb this right here, because, I mean, they're issuing, as you can see, all on the short end of the curve at the beginning of October. So we'll have to see how that goes. But right now, as you can kind of see, this is the portfolio. So what did I do recently? What I did is I sold some AFB right here. I sold about $1,000 worth of AFB, and I put it into O. It's yielding over 6%. That's a no-brainer for me. So it puts my O dividend a little bit higher than where my actual goal is, but I'll end up adjusting it out. And then the plan is to continue to add to SPHD and AFB. I'm waiting to see if SPHD goes down again before I add some more. I did add 2 shares yesterday, and then we're just going to kind of go from there. So everything I mentioned was about bonds and the market and all that. So how is the consumer doing? Well, the consumer's fine. September is very easily going to be a record month for me for income, outside of when they were sending me stimulus checks. I mean, I literally hit this right here. 1,052 is larger than anything I had all year. Even during tax time, I didn't get even remotely close to this. The only thing that's stopping me from making more is just the simple fact that the sun goes down. Um, Services like gig apps and stuff are extremely busy right now. Um, I put out a video on a related to DoorDash, and I said, I wouldn't try to pay my rent off of this, but if you need to pay a student loan, this is a pretty good way to do it. Or like a credit card bill or something like that. It's a pretty quick way to do it. Um, it's just the amount of orders are just crazy, and there's no real slowdown that I can see, which tells me that the market is living in a different world than what the actual economy is living in. Now, the two do tend to spill over into each other eventually, but when they tried to push it through 4,200 yesterday, there's just no justification for that. There's nothing in the economy right now that allows them to push it through 4,200. There are people that are bears out there who would love nothing more than to push this market down to the prior lows, but there's just nothing to do it. There's nothing broken. The banks still have the support of the Federal Reserve to buy their assets. The job market is still extremely strong. Worker claims came in low, which was a surprise. Now, other data is starting to break down, like housing's done for. But the consumer is still spending, even though retail sales are kind of slowing down. So that's why higher for longer becomes a longer problem. Because people start to get in debt, people start to try to figure out different ways to like maybe borrow money. Um, so, as you can kind of get a general idea, the only thing that's really going up right now is credit card balances. As you can kind of see, is people put more things on credit cards. Um, People aren't really taking loans against their houses. That's not really something. This is the chart that I had right here that I pulled. That was on Twitter, and you can kind of see HELOCs. These are home equity loans. Those are kind of where you would expect. Um, Home equity loan balances are not really going up, but credit card balances are starting to go up, as you can kind of see. Credit card limits are actually still going up as banks extend credit still. Um, and this isn't also kind of a thing here that's also kind of obviously showing what's going on. If you're over here, or you're in a 5-year mortgage or a 2-year mortgage or some insanity like that, this is what you get. When they raise rates, you immediately feel it. And then if you're in the United States, where we're not using adjustable rates really at all anymore, you're not feeling it. So even though rates are this high, people that currently own houses are like, I don't know what you're talking about. I'm in a 2% mortgage or something from 2021. So that's why the spending is still going. Now, what breaks it eventually is that chart that I showed before where it shows how many companies need to refinance debt over time. It's 5% of the companies this year. It's 5% of the companies next year. It's 5% of the companies after that. And then there's just a big wall in 2030, but I don't think it ain't going to be that high for that long. Hopefully we beat inflation by then and we got bigger problems. So as you can kind of see, this is what the market's doing right now. It is being driven 100% by rates. If you have not paid attention to rates in the last 10 years because you have not needed to, because they've effectively been negative, then it's time to start paying attention to them, because it's going to really affect companies that need to issue debt. Any company that needs to issue debt is immediately going to take a hit on their stock price, because that's more debt that they have to pay out, more interest out of their profits, and that's less interest, or that's less profits they can pay their shareholders. So, let me know what you think in the comment section. But like I said, the plan is to continue adding. As you can see, I started the month at 41.57 in dividends, and now I'm at 44.66. The portfolio, and I haven't updated this since yesterday, but as you can see, the portfolio is down $2,000, even though I've pretty much added 2.5 grand. Still, so this should be down much more, but so to offset that, so for full transparency. But as you can see, as it sells off, I'm just adding positions, because I do expect that in 2024, when they start talking about rate cuts for whatever reason, either we beat inflation and we can start cutting rates, or we got a recession or some insanity going on. At some point, these will go back up. But right now, you're gonna take a beating if you're just like just a buy and hold investor right now. You're taking a beating. Um, So hopefully there's a relief rally going into the end of the year just so you can have some green on your portfolios. But as it stands right now, as long as rates keep going up, long end rates right here, because we have to issue all of this, you know, and we still have a lot of debt to go through. This ain't it. We have a lot coming up after this week and the next week and the next week. It's going to continue all the way into 2024. So, let me think. Well, let me know what you think in the comment section, and then we're just riding out this bear market or whatever this is together. So y'all have a nice day. Thank you.